Now that's what happened technically, and that's what we can see. The company was here at 110 level, 101 level, then it's dropped, then it's moved up, then it's dropped. Now, if we look from 2012, you can see this lower level, then one more time, and it's again on this level. So it's quite strong support. It's the lowest point during last 5 years. Okay, so in several times it touched that point and then rebounds. It's technically okay. If we look here, we can see that it was at $37, $35 level, and then it's moved to 58. So it's $20 growth on a $35 share price. So it's what, about 80% growth, right? 70% growth. So it's fantastic, isn't it? So, and it's only 1, 2, 3, 4, 5, 6 weeks. So it's 1.5 months. Can it happen again? Read what was happening here. Probably it was a good report and the share price just jumped up after that. So that's what we have. That's what we can expect from this company, because it's undervalued. It's a quality company. If they do something like that, and it was only 2016 last year, same period, right? So we might see some similar candle after that. Okay, so that's one of the options which might happen to the company. Okay, now that's a long period. Let's have a look at the shorter period of frame. That's this area. Okay, and so that's what we can see. Flat for a while, then huge gap, then moved up. That's where from $35 it's moved to $58. Then slow down, gap down, then again flat for a while, and now it's slow down. It's another gap here. And now what we can see, it's one roll, and now we can see the second roll, but we don't see the end of it. It might continue up, it might go down now, so we don't know where to put the trend yet. We cannot draw the trend here yet, but definitely if you look at downtrend, it's broke through this. That's what's the downtrend. 1, 2 wave, and it was a third wave and didn't finish it, and it's broke through it. So it's changed direction. That's a good thing for us. We can see definitely that we can see that MACD already shown weakness here. Like I mean strength in MACD, we can see that the price might go up. So and it's actually start going up from here. It's twice moved. Now on the daily chart, stochastic is already high, so we can expect based on that it's going to pull back down, and RSI is neutral. Okay, so it's unclear. So it's very difficult to say anything about it right now. So the best strategy here is to wait, okay, and see what is going to happen within the next couple of days, and then to decide already. But it's all based on your strategy. If your strategy is long-term investing and you buy it for a long period of time, sometimes it doesn't really matter if you buy it at $35 or $37. If you're going to sell at $100 level, okay, the percentage wise, it's much better to buy it now and make it sure that you have all this potential for growth, rather than not to buy it at 37 and miss it, because it might never go to 35, and then you miss all the growth. Okay, so that's where you have to consider your own strategy. What's your strategy? Okay, also we need to take into consideration here that at the moment the market is high, and we looked at indexes, right? So we expected 5% to go down. So 5% of $37, how much is going to be? So it's $1.8, right? So $1.8. So we can expect that it go $1.8 if it goes as a market. And when we analyze value line report, it has beta 1, so it's volatility 1. So it means that it's follow generally the market. Okay, so we can expect it to go to $36 here if it goes to a bit less than $36. Okay, that's how you calculate it fundamentally and technically. And we can see it's touched level of $35, which is was into the lowest point in 2016. Okay, now based on technical analysis, if you decide to place the position, where would you do that? At what levels? Can you put it? Can you put your opinion? What would you do? What's your strategy? I am going to show it myself in the future, but it's much better if you give some ideas first, and then we compare with what I wrote. Jeremy 6 is what? Unlan, very tricky answer. Support level, buy shares. What level? Where's support level? What price? Give me the price. 35, 36, Fraser 35. Okay, great. Very good. Absolutely amazing, guys. Now, let's have a look what I wrote here. So I have 4 strategies. Okay, of course, you can choose any of them, or you develop your own strategy if you want to. You might use more complicated like option trading strategies, but basically very simple strategies here. Okay, long-term investing. If you're a busy person, you don't have time for the market, and you're happy with the company and you like the company, you analyze it, you're fully confident with that, so you can buy it at 35 to 36 dollars roughly in this area based on the trend. Of course, if we see what can happen here, if we can see that today it's continue up, so if that red candle is just for one day like last night, and now it's moved up, so we can see that we can put the trend uptrend. And if it happens like that, so we can expect that it might never go to 35, 36 dollars level already, okay, because it would be uptrends, and next one would be low 37, so you would have to readjust it. But at the moment we don't know, and we can say that it might go by like down. So if it is the top of the second wave, and we'll put the trend line here, it's like downtrend, but not as sharp as before. Okay, the slope is lower, but still it's, so it can go even to 34.50 kind of. Yeah, so yeah, but in general, if you buy it at 35, 36 dollars and hold it until 85 to 107, you might make up to 300% profit. So if it goes to 107, that's what it's going to be. You buy at 35, sell it to 107, more than 300%. Where these numbers came from? Okay, basically it came from our fundamental analysis. So that's where numbers 84, 107. You can sell it as soon as it gets the points of hold range, or you can hold it through the hold range until it comes to the level of sale range. Of course, you can hold it higher, but then you have higher chance that it might go down again. Okay, so that's where these numbers came from, based on our fundamental analysis. So, and that's what you can do. So in this case, one trade, 2-3 years sitting there doing that. Okay, but disadvantage, you don't get any dividends, all right, and don't get any income during this time. Now, another strategies value traders, for more active, who can be more active on the market, and like on lunch you were saying you want to be more active, so that's what you can do. You can buy shares at 35, 36, so same level, and now so sell it at the level of 42, 45. Now, where those numbers came from? Because we based them on technical analysis. So imagine that if it makes these rolls, okay, you bought it here. First, look at this. It's always closes gaps. Okay, so gap, close the gap, another gap by closing it, and then close this gap. Okay, so that has gap. So most likely it's going to close this gap. So it's around 40 bucks. But if you look, it's higher. So this level and this level, it's about $42. So whatever was support before, it might become a resistance. If it breaks through this resistance, it might go this here. Previous support, it becomes a resistance again. So around $45. If it breaks through that, it can go to 51. If it breaks that, it's going to be 60. But like, I mean, if you're trading, most likely it's going to stop somewhere here, $42 to $45. So if you do it, it's up to 20% profit. So which you can hold. How long would it take? Let's have a look. So how long does the loan, like one roll, last here? Okay, so let's have a look. So one roll here, November, one highest point, December, 1 month. Okay, then here we can see January, February, March. Okay, 2 months. Here we can see June, July, right? So it's 1 month usually for rise. So that's what they have, and then 1 month to go down, and then it's going to be flat. So that's what we can expect. 1 month for the big roll. So you might wait for that period. Now, is it clear with these strategies? Or if you have questions, please ask them now. Okay. Now remember, if you use these strategies, especially second one, if you're a trader, please use stop losses, okay, because you don't use options here, and you have to protect your capital somehow. So you can set the trailing stop here, all right? In this particular case, probably you won't need it because there would be pullbacks and corrections on the way, but if you're a value trader, you need to do it. So first, you put the stop loss, then when it moved up, you trail it, you kind of increase the stop loss, bring it to the area where you already have break even, then profit, etc., etc., or maybe to set it straight away trailing stop based on percentage which you want, and then just follow it. Now, then option strategy. Now I'm going to cover only 2 option strategies. I'm not going to go into more complicated spreads, but that's what I've done the screenshot last night. So left side calls, right side puts. Okay, so first let's look at BR strategy. Now again, we decided that we are not going to buy shares at current levels. Now, but there is assumption here that I buy shares right now. So and the shares at that time was 37.30. Okay, 37.25 after, like, it was market was open, so it was moving up and down. So 37.30. Now you can choose if the price share 37.30 at the money strike price would be 37.50. In the money would be 37, 36, or whatever is below that, and out the money it would be 38, 38.50, 39. So the company has really good spreads here, 50 cents only. It's very good for option trading. Now, let's have a look. 3 strategies, 3 options. One is neutral, one is conservative, safe strategy, and another aggressive strategy. Okay, we start, let's do from aggressive strategy. So aggressive strategy, we believe that the share price is going to go up. So we buy it at the current share price and we sell the call for $38 strike price. So we are giving a right to someone to buy our shares at $38. Now we are going to get 80 cents premium here. Now 80 cents premium is 2.1% profit. So if you divide 80 cents by 37.30 your investment, you're going to get 2.1%. And it will give you, if you keep doing the same type of return during the year, it's going to give you about 25% return. But if you decide to, like if the share moves up and you're right, and the share moves above $38, you're going to have 3.9% profit during next month. And within the year, it will give you 46%. So it's quite a huge difference. It's nearly 100% difference, 80% difference in profitability here. So it's like it's 25% here is 46, nearly twice as much. Okay, so that's how 8% might make huge difference in the total return during the year. Now, you're interesting here that your cost. So because you paid 37.30, but you got 80 cents, so you straight away kind of deducting it. So if the share price moves down, right, your break-even price is 36.50. So and some of you put, okay, I'll buy shares at $36, 35, 36. It's not that far from 36 from lowest point. So kind of by doing this strategy, you're already reducing the cost of your buying shares. Okay, that's one strategy. Second, that's aggressive. Now here you do it when you believe that share price going up. You can use actually 38.50 strike price or 39. The higher you go, the less you make from options, but the more you make from the move on an option. Okay, like I mean from the buying and selling shares. Now let's have a look if you do conservative. Not conservative, neutral. Neutral. We buy 37.30 and we give a right somebody to buy our shares practically at the same price, 37.50. we get $1 here. So we get a bit more, 20 cents more. So our profit, if share stays below 37.50, is 2.6. But if it goes up and our shares are taken from us, it's 3.1. So it's less than here, but it's more in this particular. So you have to be right, okay? So you decide, you choose it yourself, which strategy is more convenient. And the third one is conservative. So we believe that share price might go to $35, and you decide, wait a second, I wanna, and especially that market is high, and I wanna protect myself. And the way I do it, I sell call in the money. So $35.50 strike price. So you're going to sell it, what, $1.80 below the price you purchased. So you bought it for $37.30, but you're selling for $35.50. So it's $1.80 below the price. So, but how much you got? You got $2.20. It's actually here, it's $2.15. Probably while I was writing, the price was changed here. So $2.15. But probably when market opened, you can get really, like when you're trading, you're bargaining, you might get 220 or maybe even 230, because look at spread, 215, 240. So if you get this 220, it means that your break-even price, 37.30 minus 220, is going to be 35.11. Okay, so even if the share price goes down quite a lot, right? So like it's like you bought the shares at $35, not $37. So it's quite good. So you protect yourself by 5.85%. So, and if we looked that the share indexes can go 5% down, Dow Jones, right? So we kind of protecting ourselves by using the strategy because we sell in the money call. Okay. Let's have a look at put options. I like put options more personally. Yeah, need more homework. Practice more, guys, at the simulator. When you do few trades, when you see it, how it works, as the results, you say, "Oh, cool." Because I knew that guy, and he started doing this strategy sometimes in 2000 or earlier, even before that. And he said, "What do you mean?" And he's from Ireland. He said, "What do you mean? Like somebody is going to give me money for me having the shares, just that he has a," he said, "It cannot be right. Like it's kind of," he couldn't make sense out of it, that someone in America will give him money, you know, so that eventually he can buy his shares. He just, when he sold this call, he would draw the money just to make sure that it was real, it wasn't some kind of fake or trick or whatever, you know, and only when he did it a few times he realized that it's real strategy and it's real book. Okay, so that's the thing. Now, selling naked puts. So now the most important part, before you sell naked puts, you always have to say yourself, am I happy? You have to ask yourself, am I happy to buy the shares? Because when people buy shares, very often they're kind of quite confident, oh, I don't want the shares, I don't buy. But selling puts is like not buying shares. And a lot of people think, oh, I'm not going to buy the shares. But then sometimes it happens that you have to buy the shares. So that's why if you decide to sell naked put, you have to be able to buy the share and you have to be happy to buy the shares. Okay, so you sell puts only when you want to do that. And again, 3 different strategies here. The strike price is exactly the same, or I mean current price is exactly the same. Strike prices I took also the same. Now if you choose a so for example in our case you said that we want to buy shares at 36 to $35. That's where the strike price here, 35.50. I can give an obligation to somebody. I can tell somebody, okay, I am happy to buy shares from you for $35.50. But you have to pay me money, like, because that person afraid that the share might collapse much lower, you know, for whatever reason he afraid that it can continue going down, okay, and losing market and etc. etc. So, and he's willing to pay me 40 cents. So if the person pays me 40 cents upfront and then I pay, eventually I have to buy the shares at 35.50, what's my break-even point would be? It would be $35.10. So that's where I would like to have my shares, $35 to $36. So it's much lower than I would buy it from him. So if I'm happy to pay this amount of money for my shares, way to go for this strategy. If the share price never goes to this level, it can happen. In this case, you get 1.1% profit. So it's 40 cents on $35 investment. So annually, it would be 12.9%. So which is fantastic. I mean, banks won't give you this interest rate in any way, and it's really, really conservative. Okay, the share price has to go what, nearly 7% down, 6% down, right, before this situation happens. Now, if you're neutral, what you can do, you can decide, okay, I'm happy to buy at 37.50, so it's a bit higher than current price, but that person pays you $1.20. And if you deduct from 37.50 $1.20, your real buying price would be $36.30. $36.30. So it's a gain. It's lower than the current price. So that's why it's much more convenient. Instead of buying shares this price, we might sell put, right? And then to buy shares at 36.30, like our break even will be at 36. Now, if the share price moves up and we don't have to buy, our earnings would be 3.2% or 37 annually. And if you go aggressively, you choose 38, or you can choose 38, 50, 39, right? You're going to get $1.40. So here, actually, it's $1.50. Okay, I could get more. So, like when I was writing it, I was sure that I'm putting right numbers. Maybe because it was 4 o'clock in the morning and I want to sleep. So that's why maybe I made some mistakes. But that's kind of an idea. You get $1.40. Now you can see 150, a bit more. So it would be 3.6% monthly or 43% annually if the share moves up, okay, and ends up above 38 and you don't have to buy. If you buy it, your break-even price would be, like your purchase price would be $38 minus $1.40, which is $36.60, which is below the market price, okay, which is convenient. So that's why I like sell naked puts. I do sell naked puts only when I'm happy to buy shares at certain price, and I always look whatever I prefer. Sometimes I sell aggressively, sometimes I sell neutral, sometimes I sell quite conservative. And like for me, the question is, like for you, question is now, based on everything what we covered now, we looked at general market, that market is high. Okay, we looked at companies fundamental that is quite undervalued. We looked at technical analysis that is broke down trend and go sideways. So what would you do? What play you're going to play? Conservative, neutral, or aggressive? What would be your ideas? Can you write it down? Just curious. Okay, long term with protection at 35. Okay, great. Very good. Like, I mean, it's excellent. Some shares I buy for long. I have some shares or buy long calls as well. So we didn't look at this strategy, but that's you might trade this one. All right. But would you do conservative, neutral, or aggressive one? Sometimes in base, I found that younger people, they more go for aggressive one. The older people, they go for conservative, but not always like that. It's all personality. Okay, okay, neutral. All right, yeah, that's good. That's good, guys. Okay, so always try to be you on the market. Try to follow your gut. Okay, do fundamental analysis. Don't try to follow somebody else. Always use your own thing, because it's your money. And if you sell like aggressive one, and then share market share price always below that, and you kind of stressed about it, so it's much better not to do that. Okay, it's much better to do it lower, and where you sleep fine. It's kind of swan investor, sleep well at night. Okay, remember about this. Okay, if you don't have questions about this particular company, we'll go to the next one.